James. Thank you, James.
Cheers, Penny. Good morning, everyone. Thank you for joining today. So, I'm James Chaplin, Senior Manager of the Curve Trading team here at EDF. So I think this is the first update since May. So it's been quite an interesting market during that time. Obviously, more latest over the last couple of weeks with the Australian or potential Australian strike action impacting LNG. So we'll touch on that, but also we're approaching winter, which a lot more uncertainty creeps into the market in kind of weather forecast, demand destruction, what's going to go on with supply-demand balance. So we'll try to touch on all of that in today's presentation. But if you do have any questions, feel free to pop it into the chat as we go through, and we'll try to get through as many of those as possible at the end. So just a recap of what we're going to actually cover today, I'd like to keep the format of these very much similar. So we'll have a look at the market price action over the last 9 months or so. We'll go on to gas fundamentals, so look at kind of LNG supply, European, Asian demand, as well as some other key points. A little bit on French nuclear output, not so much of a concern now as it was a few months ago, but we'll briefly touch on that. Got a couple of outtakes from the recent IEA gas security review, which I thought were quite interesting. Obviously, hopefully some of you read the bulk of the report, but there's just a couple of charts there to touch on before summarising at the end. So let's start by looking at market prices. Now, this is just looking at a few forward contracts here. So we got September Q4, winter 23 and summer 24. Now, the scale of this chart doesn't quite do it justice because obviously it is including this time last year where we saw prices really spike just before the bank holiday weekend last August. So obviously throwing the scale off. But obviously we did actually see quite a bearish market, and I like to say it kind of started around, or really started around kind of mid-December. Obviously we had a bit of a cold spell the first 2 weeks of December last year, where that added a bit more premium to the market. But after that, we have seen more of a bearish sentiment throughout the last few months. A few factors driving that. So we saw some French nuclear capacity return, really kind of that started at the back end of November and through December. So margins were a lot more comfortable at the time. We had some mild weather forecasts. So after that cold start to December in the first 2 weeks, it was very mild kind of through that Christmas period, and forecasts of mild temperature through Q1 as well. And that was not just in Europe, that also was in Asia. So it reduced demand in Asia as well as Europe, and we got very strong LNG imports off the back of that. Fast forward to the beginning of summer. Now, the market continued to overall be quite bearish. We had easing concerns of gas power tightness. We got through last winter due to one of the big reasons, obviously, was the mild weather, which we got quite lucky with. But European storage really wasn't drawn down or relied on too heavily. So a lot of risk got priced out the curve, and attention then really turned to this winter upcoming. So winter 23. Can we fill up gas storage enough? Are we going to have enough gas to get through this winter? A bit of a rinse and repeat, but with just less risk, obviously priced in the market. Now, just looking at the chart as the scale kind of throws this off. So if we just take these lines just kind of from April 23 onwards and kind of blow it up, we get this view. So again, I'd like to say through summer, it's overall been quite weak fundamentals. We've had a lot of gas supply, storage has been able to fill up at a very strong rate. And we have, for the most part, seen prices come off quite steadily. One thing to note, and you have to probably look at a few key points in here, we have seen some big spikes on several occasions. We saw a big spike kind of in mid-June, and several occasions since where we've had the market see a bit of a short squeeze. This was on the back of some bullish news coming out. I think in mid-June there was a Norwegian gas outage in Nyhamna that was delayed from returning to service for a month. Obviously, more recently, we've had the Australian LNG strike news as well. But what this shows is how sensitive the market is to anything bullish. So whilst through summer we have seen quite bearish fundamentals over supply, there's a lot of nervousness in this market, and because we rely so much on LNG as our baseload supply of gas supply, any sort of uncertainty quickly adds a risk premium in the market. Thankfully, this has, for the most part, when this happens, has been kind of priced out fairly soon after. But obviously, one of the things we're going to have to watch approaching winter, we get to concerns around potential cold weather, competition with Asia for LNG. The other thing to draw out from here is kind of how the spreads between, let's say, the balance of summer contracts. So kind of this summer, we're quite near the end of it now. So September you were using as a reference here has really kind of detracted from the rest of the curve. Now it's detracted from kind of the winter 23 already at the beginning, but even the summer 24 is trading at quite a sharp discount too. Now, I think this really shows the difference in fundamentals from this summer to the uncertainty we have in winter 23 and beyond. We'll have a look at the gas storage chart in a bit, but we have a very good supply so far. We're going to be able to fill up storage by the end of this summer. Winter 23 is when the uncertainties come in weather, the demand destruction, other supply, and then again, summer 24, winter 24, it's a bit of a rinse and repeat. Where are we going to end winter 23 in gas storage? Are we going to be able to fill that up through summer 24? Are we going to have enough supply for winter 24? And again, a rinse and repeat further on. And I think that's just the structure of the market now, with that kind of reliance on LNG and all the uncertainties. We're going to see that play out until we get certainty around those fundamentals until closer to the time. So I talked a lot about, or alluded a lot to, gas fundamentals in that first bit, but let's have a look at some of the key charts. So again, we always show, I think, majority of these. So first one we'll look at is European gas storage levels. Now, again, just to recap, this is showing absolute storage levels. So obviously we fill up through the summer months. So generally start injecting and putting more gas into storage from around kind of late March, early April time when demand comes off. And we fill up right through to summer until the beginning of winter. And it's typically when we start to get cold weather. So kind of mid-October, potentially even the back end of October is when we kind of flip from injections into withdrawals. Now, focus on the blue line, so 2022 for now. Obviously, we know what happened last year. We finished winter fairly low on storage. We had a lot to put in to storage over the last summer, and we actually had to continue injecting into early November. Now, we did get quite lucky. October, November were very, very mild across Europe, so we didn't have too much demand. We were able to put a lot of gas storage into stock, and we didn't actually start withdrawing until kind of mid-November time. Obviously, again, we got lucky towards the beginning, or kind of through Q1, where we had very strong LNG supply as well as lower demand. But looking at the red line now, you can see we didn't really need to draw down and rely too much or too heavily on gas storage levels through the start of this year. We ended winter, kind of the end of the March level, at record highs, so above where we saw even in 2020 in the COVID year, where obviously demand reduced significantly. Didn't put too much stress on us having to fill up at such strong rates this summer, obviously having to do that without a stable and high Russian gas supply. And we've been able to put in gas at a very steady rate, and obviously at seeing kind of record highs for this time of year. So looking forward, I mean, it looks fairly comfortable to put in gas over the next few months, be ready for winter. I suppose the uncertainties, which we'll touch on in a bit, come kind of mid-November, mid-October, November onwards, where we get the cold weather risk, we get the competition with Asia kind of creeping in to the market. Now, looking at LNG, again, show this slide quite a lot. So this is looking at LNG imports into Europe, split by the source as well. Focus more on the right of the chart, and we can see kind of from October 22 throughout winter and into the start of the summer. So until actually May this year, so April, May, we got very strong LNG supplies every single month. Obviously, that helped us through the winter, helped us really kickstart our storage injections at the start of this summer. But focusing on the last 2 months of full data we have, and August is very much kind of in line, maybe even a bit lower, we have seen quite a significant drop off of LNG supply into Europe. Now, obviously, we have maintenance schedules in summer impacting LNG supply around the globe. That is natural. You put in your kind of maintenance schedules in summer when demand is lower. So we were expecting some tick down, but also we didn't really need the gas. As we showed in the previous chart, we're filling up storage at very good rate. Demand is low in the summer. Demand destruction is still about as well. We would have got into a situation of oversupply. So we actually went discount to the Asian price, and some LNG started to turn away, just small amounts, turn away to Asia through that time. Now, looking at the kind of the price difference between us and Asia. So again, we show this on a regular basis. So in blue, we've got the Northeast Asian spot price, so kind of market for the JKM, so China, Japan, Korea, and the TTF, so market for European gas prices. Now, probably have to squint to see kind of the bottom right of this chart here. You can see the orange line. So the European gas price was a premium through the start of summer. We had a lot of supply coming through to us. However, kind of in June, July onwards, we actually have gone or stayed discount to the Asian price. They've gone premium. Obviously, they've entered their cooling season, lots of air conditioning demand. They've been refilling stocks as well. So again, some cargoes have shifted away from Europe towards Asia, but again, it's at a time when we don't need to fight too much for it as well. We're happy getting a little bit of gas supply, filling up storage, still at a very strong rate at the moment. Now, just to delve a bit deeper, so what we saw on the previous slide was just kind of the spot cargo. So, kind of what is the price difference between the Asian price versus the European price for a spot cargo now to be delivered kind of month ahead or so. Looking at longer term, so looking at the price curve over winter, we kind of get this view. So, what this is showing is the difference between TTF, so the European price, to the Asian price. When we see a negative here, it means that the European price is a discount to Asia. And therefore, Asia, if shipping costs, time for shipping, etc., was equal, it'd be more profitable for those cargoes to actually be shipped to Asia. Now, there is some complexity in that in terms of particularly US cargoes. It takes them a lot longer, a lot more money to actually ship to Asia. So they need quite a big spread to be able to be more profitable to go to Asia instead of Europe. But cargoes from, say, Qatar, it needs a less spread. So if obviously the Asian market is premium, they'll turn around and go to Asia instead. So this is just something we'll have to monitor quite closely through winter. We're seeing, 4-5p discount in Europe through Q4. Obviously, we're very strong on gas storage. It will depend on weather when our demand really ticks up. If it's going to, cold weather is going to start in October, or if we're going to see like last year where it's kind of more back end of November where demand really ticks up. But I suppose we already are seeing very strong discounts, particularly in January and February as well. Obviously, that is our highest gas demand time, both in Europe and Asia. But obviously, we'll have to see if that gets to discount. We could see more and more cargoes turn away from Europe and go towards the Asian market. The other thing to monitor and something we see good to keep an eye on all times of the year is Norwegian outages. Now, they obviously always put in planned maintenance through summer. Typically, it's at the beginning of summer, so kind of around April, May time, and then they'll do another round of strong outages towards the back end of summer, right before winter. So they hopefully can supply without too many hiccups through the winter time when our demand is high. Now, we had some uncertainty in kind of their first load of outages, where one of the plants, Nyhamna, was extended for about a month, taking about 80 MCM per day of supply off for an extra month. But we're upcoming to the next big schedule of outages kind of in this period here. So I think they're really ramping up kind of today, tomorrow, and over the weekend. And we're getting to quite strong, so maybe like 160, 170 MCM offline. You compare that to total Norwegian output, which roughly kind of outputs at full capacity around 350 plus MCM per day. So it's all planned. It's all, these should all be kind of priced in the market. However, if we do get extensions or particularly long extensions to some of these outages, again, we've seen how sensitive the market will be, and there will be or potentially could be market reaction off the back of that. Hopefully everything runs to plan, but again, it's just one of these things the market has been quite sensitive to, particularly at the beginning of summer. We'll be keeping a closer eye on it over the next few weeks. But most of this outage should end obviously by the end of September, and we should get strong Norwegian output from the beginning of winter. Even if we get a cold start to winter, hopefully we've got strong pipeline supply from Norway. Now, probably one of the hottest topics over the last 2.5 weeks, I'd say. I can't remember exactly when the news came out, but Australia LNG strikes have been moving the market considerably, adding a lot of volatility to European hubs over that time. I think it initially came out around the 10th or 9th of August of this month. But essentially what we've had is two companies involved, so Chevron and Woodside, and their terminals, their employees threatening to strike. The impacted terminals here, so this just map showing all of the European, all of the Australian infrastructure around, but we are kind of highlighted in red the three which could be impacted, which are Gorgon, Wheatstone, and Northwest Shelf. These three combined account for 10 to 11% of the global LNG supply. So massive, massive impact to global LNG if they were to go ahead. And obviously in Europe, with the reduction in kind of Russian pipeline supply, kind of stable supply, our baseload kind of supply of gas essentially comes from LNG. We're a lot more reliant on it. And therefore, if we do see 10% of the global LNG shut down, obviously all of Europe, all of Australia's LNG typically goes to Asia. However, then Asia will have to compete and get some more cargoes from Qatar, from the US. They'll drag that supply away from Europe, and we're essentially getting into a bit of a bidding war if we both needed the LNG at the same time. So been keeping a very close eye on the developments of this. Any kind of news headlines that have been coming out have been moving the market quite substantially. The latest developments we've seen on the Woodside part is they actually gave notice that if they didn't get an agreement by Wednesday, which was yesterday, they would give their 7-day notice to start striking. So they could have started to strike as early as the 2nd of September. Now, a strike could come in many forms. It could involve, full shutdown of the platform, or it could involve just, 4 hours a day, which wouldn't impact supply. But obviously, the market thinks, what could happen, what is the worst case. Thankfully, on the Woodside part, they have come to an agreement in principle. That news came out overnight last night. I think they are due to vote on it. The union are due to vote on it at 11:30 today. So very shortly, and it was that 15 minutes. I can't see the time of them in 15 minutes or so. So that should all be resolved on the Woodside part of things. The other part is impacting Gorgon and Wheatstone, which is owned by Chevron. And I think that will be ongoing. I think Chevron actually gave an offer directly to employees bypassing the union, and the latest news at 9:30 this morning is they have voted in favour of a strike. But again, negotiations are ongoing. Hopefully, they can use the Woodside kind of framework to get a resolution there. But again, the market will be quite jumpy and volatile on the back of any news coming out there. So quickly on French nuclear output, and not too much to say on this in terms of, we've talked about it quite a lot in previous presentations. It's not so much an issue at the moment, but this chart is just showing nuclear output over the last few years in all the different colours. On the black line, 2022, you can see why we were quite concerned. Very low nuclear output through the back end of the year, and only ramping up kind of from back end of November, December onwards. And obviously, there was concern if this was delayed, and we saw cold weather, could we see some blackouts across Europe? Thankfully, we didn't see that. Nuclear availability returned. We saw mild weather as well. Now, in the red line is nuclear output so far this year. And you can see, although it's below kind of the average range, we have seen fairly stable, fairly good supply. And they are still targeting what they previously said of output earlier in the year. So hopefully no more hiccups. And we'll see even more availability come online over the next few months. Now, we'll just see kind of the impact that has had on the UK and France winter pricing. So again, we're just seeing here on the left-hand side, winter 23 baseload, on the right-hand side, the peak contracts. And we're just comparing in orange the French price and in blue the UK price. Typical thing we can see is France has been at times a very, very strong premium to the UK. And this is because of all the uncertainty on French nuclear output, adding all that risk premium into the forward market in France. However, more recently, with more confidence coming out of the French nuclear generation output target for the rest of this year and the start of next year, we've seen that spread considerably narrow. And I think it's even narrowed further since I kind of took a snapshot a few days ago. So only seeing an £18 per megawatt hour premium in France for the base and £50 on the peak. So that has narrowed vast amounts over the last few months. So IEA gas security review, and again, if you are interested, please do do search online and read the report. So there's some quite interesting stuff in there. I just thought I'd talk about two parts. One is around demand changes we've seen from the first half of 2022 to the first half of this year. And then we'll briefly touch on kind of some scenarios they had for this winter. Now, what this chart is showing is the supply and demand differences we've seen in kind of first half of 22 and 23. So look on the left-hand side for now on the supply side. Now we did see a tick up in supply from several sources. So kind of in the green, we had obviously global LNG supply increasing, particularly from the US. Some more domestic production in Europe and China. Norwegian output has been particularly strong during that time, and some extra Russian piped export imports from for China. Big decrease in supply. The big blue chunk there is the reduction in Russian piped imports into Europe, as well as some other things there. So big reduction overall in supply in comparing the two timelines here. But on the demand side, we've more than kind of outdone it, I suppose. So China, we have seen a tick up in demand. Obviously, half one 2022, they did have COVID restrictions in place. That is not the case anymore, so their demand is up. One of the key uncertainties we have going forward is the economic recovery. Obviously, if they have a very strong economic rebound, their demand could increase at substantial rates, like we did see the previous few years before 2020. So definitely one to keep an eye on. But in other countries, we did see quite a sharp reduction. So Japan and Korea reduced their gas demand a fair bit. We've had some nuclear units come back in Japan. But in Europe, obviously, again, there's that big slug. So again, mild weather would have fed in, reducing demand in Q1. But we also did see very sharp demand destruction. Obviously, the high price environment, people used less. Essentially, they turned down their usage on purpose. And in countries like Germany, I think they had some restrictions in place as well to reduce usage overall. So I mean, highlight from this is, we got through last winter. It wasn't all from kind of an extra increase in LNG supply, LNG contracts with the US. For the large part, it was the efforts to reduce demand, which obviously is going to be a key thing going forward. Are we going to see the same levels of demand destruction this winter as we did last winter? And obviously, what is the weather going to be this winter? Right, on to, I suppose, kind of an IEA forecast here. So this is looking at 4 different scenarios, and it's looking at European gas storage fullness at the end of every month through winter. So that's all the different colours bars, October all through March. And we've got 4 different scenarios. So kind of the left block, we've got a mild winter with static LNG supply, all the way down to the right-hand side where we've got a cold winter and low LNG supply. And they've tried to kind of put on a threshold here where we get to heightened risk of supply disruptions. So I don't have too much to say about this. Obviously, didn't do. This is the IEA work. They have some more information in their reports, but it does show kind of how sensitive the market can be. If we do get a cold winter with more competition for LNG, we can withdraw on gas storages a lot more. But kind of in the base case where we are continuing high LNG supply into Europe, we have even a kind of a mild or even a slightly cold winter, we should be okay. But definitely it's going to be one of these points to watch is, the LNG competition with Asia particularly, and weather forecasts. Right, just to summarize, and not too much, I don't want to put too much on this page, but overall, I think fundamentals are quite different for this summer and kind of winter, where this summer we see very strong gas storage levels. We're very well supplied. We should get to full before the start of winter. However, there are very key uncertainties remaining as we approach winter. Australian LNG strike action is definitely one. We have got some positive news over the last 12 hours or so. Market price has come down substantially from Tuesday to reflect that. We do still have some of the uncertainty around Chevron, but I think something like this just demonstrates how sensitive the market can be to this sort of news. If we do see any more kind of supply disruption from strikes or kind of another factor, that could filter through to European pricing as well. Second, and this is going to be very key, is European demand. So levels of demand destruction we're going to see. Obviously, we saw very strong demand destruction last winter. It was, top of the news most days of how high energy prices were, and people put a real effort in to reduce their demand. It remains seen, is that ingrained now? Are we going to see reduced demand going forward this winter? People are going to hold off turning up their heating, or is it everyone's kind of used to or more used to it now, where we're going to see a lower level of demand destruction? And secondly, obviously, weather development is going to be very key. Everyone gets a bit nervous around what the weather is going to be in winter around this time of year. At the moment, obviously, it's going to be very uncertain forecast, but we do have what is called El Nino weather pattern. Now, typically, that could bring a potentially mild start to winter, but it could then also bring a sudden stratospheric warming risk in Q1. So SSW risk in Q1, which could bring colder weather at the back of Jan into kind of Feb and March time as well. So a bit uncertain. We'll see how this develops. Again, this early on, it's going to be very uncertain, kind of looking at any weather forecasts. But as we get closer to October, I'm sure we'll be keeping a closer eye on it and kind of also commenting on our Market Insight portal, the impact in the market and kind of the long-term forecast there. Lastly, again, big uncertain one here is Asian demand, and particularly the rate of Chinese economic recovery. They're such a big gas user, and their LNG demand can go up substantially. Obviously, the weather's going to play a big impact, but also, how fast they're going to recover economically will play a big part in how much LNG supply do they need. Is that going to impact supply coming to Europe as well? And that's all from me. Hopefully gives a good bit of insight, but I think we're open up to questions. Thank you.
Thank you, James. I'll start with some of the pre-submitted questions. I know you have answered some of those anyway within your presentation, so I'll go through the few that we have left. So we've got a question actually. This one's more around non-energy costs. So someone's asked for visibility of the new TNUoS costs and the long-term implications on electricity bills. We've actually got a monitor report being published in the next couple of weeks, and we have a webinar that follows that, Monitor Explained. So if you go over to the Talk Power website, you can register there, and that's where you can get all your ask all your questions, get all your answers around the non-energy costs. Next question, so main points. Sorry, please can you give your view on what elements of the price premium for summer 24 and winter 25 power curve is winter 23 weather risk, and what elements low trading liquidity?
Yeah, so I think this is going to be, I think this is kind of what we touched on a bit earlier, where we saw kind of that summer 24 price versus say this summer has detached quite a lot, because we're more certain of the fundamentals this summer, where we've got a lot of gas supply. We're doing very well on gas storage. Next summer is always going to be contingent on where do we finish at gas supply for this winter. How are we looking? Are we going to be able to fill up in time for winter 24? So it's very much the market we're in, at least for next year, maybe even the 2025s or further as well. We're so reliant on LNG, it's going to be kind of a more nervous market until we get more certainty. So yes, summer 24, winter 24 could well be driven by kind of weather fluctuations or any other fundamentals which impact this winter.
Thanks, James. I'll go over to the live questions now, because I think looking through the rest of those pre-submitted ones that you've covered them. Okay, so Russian LNG into Europe didn't seem to have changed much over 21 to 23 period. Was this surprising?
I think it was initially surprising. So I think, everybody thought there might be sanctions on Russian LNG cargoes coming into Europe, and that's just something they've left untouched. So the main turndowns have been kind of the pipeline. So the Nord Stream pipeline into Germany, Velke's reduced, and also reverse flows seen in kind of Maunau. It's definitely a risk going forward, where they're still supplying, I think, around 41 MCM per day through Velke, so through Ukraine. That is definitely a risk to be reduced going forward. I think that contract runs through to the end of 2024, and Russia have said they're not going to renew it. So not expecting flows through there in 2025 or beyond, but definitely they could reduce it before that. But yeah, definitely on the LNG side, we would have expected some sanctions there, but they just haven't been touched yet. So definitely one to watch. But I suppose on the LNG, at least through summer, it doesn't matter so much because they could send those cargoes to Asia instead. But yeah, I think we'll just have to watch on kind of what the sanction action is there, but no news recently.
Okay, thanks, James. And then the next one we've got come through is note that the UK has been using coal this summer. With coal being phased out, will this impact next year?
Yes, potentially could impact next year. So too bad. I haven't kept too close on how much coal has been running. But yeah, obviously when we phase out more kind of flexible supply out the stack, we have to rely on other sources. We're going to have to rely on other gas stations to run or other sources of flexibility as well. So batteries, gas peakers. I think they're going to be important. Obviously, the issue with renewables is you can't tell it to be sunny, you can't tell it to be windy. So you do need some excess supply to kind of meet your peak demand. And I think in the future, that's going to be more batteries, more gas peakers, etc., coming online.
Thanks, James. And then our next question. So what percentage of LNG global supply are Chevron responsible for? They're just trying to understand the risk that Chevron potentially striking presents to EDF.
That's a good question. I don't know how much Chevron has total. I think the strike action here only impacts the two terminals we're talking about, so Gorgon and Wheatstone. And I can't remember the top. I know the three sites altogether was around 10%. I think just the Chevron element might be around 7% of global supply there.
Okay, thank you. So next question, if price fundamentals looking stable, is there strong potential that the current demand destruction is reduced?
It definitely is it's something to keep an eye on. I think we're approaching Q4. I think the Q4 SVT, so the residential price cap, I think that's just been announced this week, and it will look to be kind of a reduction from the price cap in Q2 and kind of in what we've got now in Q3. So people's bills, if you are on a residential standard rate, that will drop when you get to Q4. How that impacts customer behavior, we're not too sure. Obviously, if their bills drop a bit, they might not put the effort, as much effort in to reduce demand as they did last year. But yeah, it's something we're just going to have to watch. I mean, it's one of the hardest things to predict in this market. You're predicting, countries' behavior based on usage.
Thank you. And then the next question that's coming, do you think small modular reactors will be able to take over baseload in the future?
Good question. I'm not too sure. It'd be a good one to look into. I think we are a while off on that, unfortunately, though.
Thank you. This question is probably not relevant for this webinar, but perhaps you can give us an answer. So what is your view on integrated battery storage facilities and their future on UK power networks?
Yeah, so I mean, batteries are going to be pivotal in the future. I know in the UK we've ramped up battery capacity substantially over the last few years. I think here at EDF we are the largest kind of optimizer of batteries in the UK. But yeah, no, they're going to be very important, as we said, with the kind of the transition we've been going through over the last few years and continue to go through the next few years, with the having more renewables online, phasing out more of our flexible generation in kind of coal and gas. We're going to need some more kind of other flexible assets, so kind of batteries, as I say, gas peakers, to kind of step up and kind of fill that gap especially when renewables is low. So yeah, it's going to be very, very important to the system going forward.
Thank you. I think that might be all our questions, unless anybody wants to submit to anything else.